We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Gareth Soloway, President, CFO, and Chief Market Strategist of InTheMoneyStocks.com. Thanks for joining me today, Gareth.
Hey, thanks for having me, Tom. Always a pleasure to be here.
Excellent to have you back, and thanks for fitting me into your schedule. I wanted to have this recording included this week since it's a fairly big week. We're making another high in the S&P, and we have a lot of interesting news coming out pretty soon here ahead of the Jackson Hole meeting. So why don't we start with the S&Ps? We have confirmed another high today, and you and I spoke before we hit record about breaking this trend line and this wedge pattern. So why don't we start there and get your thoughts on what the S&P is doing?
Yeah, absolutely. So I think it's important to recognize here that the S&P has broken down below the key wedge pattern that I've been watching. And in fact, Tom, I don't know if you can give me the ability to share my chart there, but I would love to show the viewers here.
Go ahead. Sorry.
No problem. But yeah, so I'd love to show the viewers the chart of the S&P here. I think it'll be very insightful to see what's going on. So I talked over the last week about this breakdown that confirmed below this wedge pattern. And remember, this wedge pattern goes all the way back to this March 2020. So it's incredible how long we've been kind of stuck in this wedge pattern. You can see the two lines converging up at the recent highs. Now, we did break down right here, and we confirmed. We then have seen a reversal to the upside, but look at where the S&P is hovering, right up against that. So a lot of people are saying, okay, well, has the S&P negated the potential breakdown? And the answer is not yet. So what I would want to look for is, do we confirm back above these trend lines? Do we break to the upside above this wedge and then confirm on that side? If that does happen, then that breakdown, the confirmation breakdown, is negated. The fact that we're retracing is what's called a retrace to the scene of the crime. In other words, we broke below this trend line right here. We closed, we confirmed, and now we're revisiting that same trend line. Now, one of the interesting things that we've seen lately, so I've talked recently about how the mornings you would see some institutional selling pressure, which would drive markets down, and then individual investors would float the market back up throughout the course of the day. That has stopped in the last week. And a lot of people are saying, well, why has that stopped? The answer to me is twofold. So number one, Jackson Hole. So institutions are no longer dumping in the morning because they're waiting to hear any new words from the Fed. They're basically sitting on the sidelines this week. The other thing is that the late August period notoriously is when the big institutional traders go on vacation with their families, with their kids, prior to the kids going back to school. So just to give you an example here, the spider volume today, and again, we're doing this after 2 p.m. Eastern time, so there's less than 2 hours remaining. We are on pace. We only have 18 million shares traded. We're on pace for the lightest trading day of the entire year. And that's including, holiday sessions and everything. So again, you're getting this market to float up with very little conviction, meaning that there's no institutional buyers. You're retracing to resistance. And it also creates this scenario where we haven't negated this potential breakdown. Now we could, but right now we have not.
So in that chart that you were just showing us, is that a daily chart, Gareth?
Yeah, correct. It is a daily chart. And again, each candle represents one day. So again, this last move has been 1, 2, 3, 4, 5. So it stretches basically 1 week ago would have been this pivot low right here.
So if we were to look at a weekly chart of the same thing, would we see a cleaner version of the exact same thing with, yeah, absolutely. So it does look like it respects that trend line a little bit more, right?
Absolutely. You can see it. And by the way, on the weekly, what's remarkable is that, early on in the initial move off the COVID lows, you could see the volatility, how we went up big and then we pulled back bigger. And then look at over the last, this would be the last 3 or 4 months, how tiny the candles are and how little we're going up. So again, when you see a market that is having, even though it's making new all-time highs, you have to just be a little careful because there's no conviction there. And when I say conviction, I mean, there's not big money. Big money is not jumping in up at these levels. If anything, we've seen a little bit of selling early in the mornings until this last week, which has been institutional unloading. So just be aware of that there are some signals here that continue to be there. Not only have we still confirmed to the downside, even with making a new high on the S&P, but again, the institutional money is not buying this market, which to me is always an indication, right? I mean, if there's players out there that know things even more than me or more than anyone else, it's institutions that have billions of dollars on the line and can pay people and pay massive teams of people to do their research.
So as we were talking about the Fed FOMC or Jackson Hole meeting coming up, are we likely to see them actually start to taper in September?
It does seem like that they're on that path. Now, one thing we've learned with the Federal Reserve is that even the slightest little hiccup can throw them off from doing that. But I think they're getting boxed into a corner here where inflation is becoming more and more apparent that it's not transitory, right? Now, it's not to say that inflation, which is currently in the last 12 months, like 7.5%, 8%, it's not going to come back. It is going to come back to about 5 or 4%, but it's not going to come back like the Fed has always said, which was back to around the 2% mandate that they want. So the Fed is in this position of saying, okay, well, here we have the Delta variant wreaking havoc, but you're not seeing the shutdowns. Inflation continues to be pretty enormous, especially with wage pressures that we've been seeing out there. And so they're going to have to act in some regard, right? So my guess is they will start to taper. They'll probably do it in November. So they'll probably announce it in September at their September meeting. And then I think November they'll start it. And they're going to do it very slowly. They do not want to freak the market out. So you're looking at maybe instead of 120 billion a month, they'll drop it to 100 and then maybe a month or two later to 80. And they'll do it in a way that is so slow that it's almost like the market, they hope the market doesn't even pay attention, right?
So you were also mentioning that this is the lightest volume day of nearly the whole year, or we're on pace to get that. So how do you trade around this? How do you take that into account when something important like this is coming up?
Yeah, so this is where it gets tricky as an investor, right? So you have Jackson Hole, that there could be or there could not be some major news out of that. We just don't know as investors and traders. It's really up to Jerome Powell if he wants to do any sort of news break. With the light volume, so light volume normally is a neutral to upside bias signal. So basically, light volume comes from smaller investors, which they don't have the billions of dollars that the institutions do. So the bias of the small investor is always going to be bullish, right? I mean, think about everyone out there. I mean, if you talk to my parents, they really don't know what shorting is. Most people don't know what shorting is out there. So inherently, they're programmed by the media and by institutions to always be buyers. So if you do see a light volume environment, it's probably small investors just inching into positions, and that's enough in this environment to lift the market. Now, you have to put that on the opposite side of a chart like I have on the S&P that is blaring orange and yellow and red signals to me that something is amiss here. So as an investor and a trader, I have to kind of just say, okay, this is what the charts are saying. But maybe it just kind of goes sideways here until we get better volume once we get into September. And that's usually what happens, folks, is that late August is quiet. And then once you get into September, you start getting normalized volume.
Excellent. So what are the charts saying here for this type of correction that you're calling for going forward? Could we get a dramatic drop, or is it more likely to be, a start of a grind lower to begin with?
Yeah, so I think what's important is you'll get individual days that are likely to have big drops. Now, again, on the way down, there's going to be key supports. And by the way, looking at the S&P here, I want to show you guys something. So even with this trend line being broken and we're trading back into it on the underbelly side of it, you have to notice that you still have higher lows and higher highs. And as a trader, that's the first signal I'm looking for, which is a lower low. So, I mean, going all the way back here, low, higher low, higher low, higher low, higher low. I mean, all these are higher lows and higher highs. So the biggest kind of signal that something is underway for me would be if we started to fall and took out this most recent low pivot right here on the spiders. That would be like kind of an aha moment where we would say, okay, now we have a lower low. Now let's see if we bounce and make a lower high. Now, individually, because especially the volume is low, you can get big drops if just one institution decides to dump or something happens news-wise. but understand that early on in a down cycle doesn't collapse. You don't get crashes at the highs of markets usually. What ends up happening is you'll get a few days of dips, and then the buy the dip mentality steps up and pushes the market up. Now, what we'll be looking for is the next time we dip, if we make a lower low, when that buy the dip comes back in, does it not make a higher high? And once you start making lower lows and lower highs, that's very, very bearish for the market. So ultimately, I think the correction could be in the tune of 10+%. But again, it's kind of a stepping stone for me. It's like, okay, well, we've broken this trend line. Now we're doing a retrace to the scene of the crime. Now the next step would be lower lows, then a lower high as the buy the dippers come in, and then another lower low and so forth. When you get big crashes, the biggest down moves, if you go back to 2008, 2009, the most panicked period was basically the beginning of 2009, just before the market bottoms. The reason it happens at the end of cycles is because investors at that point will not buy the dip. There's only selling in the market. There's panic selling. So at the beginning of cycles, always remember that it's going to be a lot of chop, which is actually good for swing trading. You'll get big down moves and then big bounces.
When people are buying the dip.
Exactly. 100%. Yep. And then again, the key being that when you see these bounces come in, if you want to know if you've now really turned the corner to further downside, look for that lower high and lower low.
Right. So you've also spoken before about the deleveraging in the system that will occur. So can you explain this more to our viewers? Would this start by a rollover, just as we were talking about, followed by margin calls? And where does the majority of this leverage in the system exist?
Yeah, this is a really interesting scenario because inevitably it's going to happen. It happens in every crisis. And the main reason is because especially over the last 20 plus years, the Federal Reserve has kind of had this free money policy. And then what will end up happening is people take advantage. You can't fault people when interest rates are low for leveraging themselves to the hilt when you have such low interest rates. They're paying such a small amount. The market or Bitcoin or anything is so good in terms of paying out with profits that they say, well, why don't I just use 10 times margin or 100? Now, obviously in stocks, you don't necessarily get that, but we have seen that in cryptocurrencies to some extent. But basically what ends up happening, folks, is that it could be something as small as the Federal Reserve tightening and interest rates going up. And then it could cause the brokerages to say, okay, well, now we're going to raise our margin interest rates. All right. Now you raise interest rates, which cause some people to say, okay, I'm not going to pay this interest rate on my margin loan of $1 million or $100,000. They end up selling a little bit. It could also occur with a downtick in the market. When you have so much leverage in the system, if you just get a 5 or so correction, 5% correction, it'll create margin calls, which then cause more selling and more margin calls and more selling. And it basically, just like the upside has been in one direction, it can create a pretty strong sell signal and sell action in the market. So, I mean, it's pretty nuts when you have this much leverage in the system. I think we saw recent data saying that, U.S. consumers have more debt than they've ever had now, something like 17 trillion. I don't even remember the exact amount. Now, granted, housing is in that number, but it is a remarkably high number of high amount of leverage.
I spoke with another guest on Monday, and he was saying the exact same thing, that margin debt relative to the S&P has never been higher, or it's at real all-time highs.
And I think it's important to understand is that the Federal Reserve they're the ones that breed this, right? I mean, they're the ones that control interest rates. And we know as interest rates go down, the cost to borrow money. And you've seen this, by the way, with corporations. Corporations have been, taking out loans to buy back stock. They've been taking out loans. I mean, it's incredible how it goes through the system in terms of everyone taking out more and more leverage and doing things with that cheap money. And again, the question is at some point there has to be that deleveraging where whether it's the external market forces cause interest rates to go up, where other countries might say, hey, we're not going to lend the US another $50 or $100 billion at 2% or 1% because we don't think they can pay it back even in 10 or 20 years. Or it could just be something else where you do have the Federal Reserve actually tightening, but it will come. There's no doubt in my mind. And that's really where the scary part could be. I mean, I've said 10% correction. But if that deleveraging event occurs, you're talking about much, much more.
So where is there an opportunity that still exists in the markets, Gareth? We've spoken before about Chinese stocks. So is there still an opportunity there right now? And maybe lay that out for us.
Yeah, so Chinese stocks just had one of their biggest bounces that I've ever seen yesterday. Really incredible. Stocks like PDD, Pinduo, if we bring up that chart here, literally from the lows of late last week, Thursday, Friday, we saw 30% moves to the upside in that stock, and it's still, in the scheme of things, oversold. Now, you want to let these things come back in, but there's absolutely no doubt. And I did take profits yesterday on PDDD, but there's a gap fill right down here at around $80. And if somehow this stock came back to $80 or 81, I would absolutely be re-entering. Obviously, understand the risks of investing in China right now. It's a wild card, but to me, when there's a lot of risk, usually it comes with a lot of reward. And that's the type of swing trade that I usually go for. And again, I said this when I was last on with you, and I'll say it again, is that, to me, it blows my mind. There's so much fear and panic. And then when you look at some of the regulations that the Chinese are putting in, it's like, companies shouldn't leave fake reviews, or companies shouldn't drive fake traffic to their websites to make themselves look bigger. It's almost like, common sense type things that I'm not necessarily sure is a bad thing long term. Now, regulation, anytime when you're dealing with a kind of a dictatorship, is always scary, but it actually could turn out to be a good positive for these companies going forward. And it might even be part of the hopes that the SEC, which said these companies have to have audits and so forth in 3 years or they're going to get delisted. This could be what the Chinese government's trying to do is make these companies more transparent, put them in front of the world, and then get more investment dollars into China as a whole. Again, speculation on my part. I have no idea. One other stock I do want to bring to your attention, which is interesting to me on the long side, and generally, just to be clear, indices I'm short here up in this range. I added a more shorts today on this kind of gentle float up, just trading the chart for me and being careful, obviously. But one stock I continue to hold on the long side is Viacom. And obviously, we've talked about the potential for a buyout here. But one of the chart signals I really like is take this pivot high and then drop it right down through this area, right? So pivot high to this little high pivot, and you pierced it here. And then look at how it's potentially broken out. And we can even make a case for a wedge pattern breakout here by connecting these recent lows. And I know it's hard to see at the low end of my chart, but look at how you can connect this low to this area, which connects then through this area and this area. And you can easily see how you've broken out to the upside. Now, will this turn out to be a bigger move to the upside on Viacom? Again, anyone's guess. But in the past, I've said, you show me a company that's trading at a forward PE of 9, that pays a 2.5% dividend, that has the growth in streaming that these guys do, the potential for a buyout. And it's a company down at these levels with everything else at all-time highs that I'm more than okay at investing some money into. So there are opportunities out there on the long side of the market. You just have to, in my opinion, be very, very picky. You don't want to get into something, in my opinion, that's at all-time highs. Like, I'm not someone who's buying Apple up here. I'm not buying Microsoft. I look historically at the PE ratios of stocks like this and then compare them to where they're trading now. And it's honestly ludicrous.
Absolutely. It's almost, in a way, you're matching value and growth in that case, right?
Yeah, exactly. And then just doing the best you can in a market that potentially could turn down at any time. And again, you just want to, it's part of the diversification process that every investor should do. Excellent.
So let's move to gold now. Where do you see the important support levels and resistance levels in the gold chart? We've really seen, gold kind of trade sideways, go back up through the $1,800 level and get kicked back down here in the last day. So where do you see those levels, Gareth?
Yeah. So gold. So we did see this big dump out in gold, right? And that was recently. What I thought was so, and here I could show it on my chart. So you had this dump out on gold. And I still remember there was so much panic out there when this was occurring. Like, oh my gosh, gold is collapsing. How low can it go? And all I was seeing was buying opportunities as gold goes down. And anytime gold dips, I just remind myself of the thesis of long-term gold holding. And it's kind of the same thesis as Bitcoin. It's just that Bitcoin's a lot more expensive, in my opinion, still, and has a lot more kind of, amateurish money in it that I do think needs to be flushed out. But eventually Bitcoin becomes the same kind of avenue to upside as gold. But bottom line is, this dip occurred just as Bitcoin was breaking out above that 40,000 level, which is currently trading just under 50,000. And then what I loved about gold, which was so bullish, was you within days, you recovered that entire move to the downside. And again, when I see that type of quick buyback, it screams institutions saying, okay, this is the dip on gold. It's going to go higher no matter what. I mean, these guys, again, are ones that can see things even better than I do. And they're the ones obviously picking it up down here. It wasn't, John Q. Public saying, oh, well, I'm going to sell my Bitcoin on this breakout and then buy gold back in. I mean, we know that that's not necessarily happening. So that was very bullish when I saw that. Now, having said that, you came right into this choppy sideways action. You're right back there. You're pulling back a little bit today again. This is the area that you want to see gold get through in the short term. And I can put a trend line right here on the GLD. If it can break above here, then I do still think that there's a chance to get to this breakout trend line right here, which is kind of an inverse head and shoulders pattern. And that would be the bigger breakout on gold that could send it to a price target of $2,100 by year end. But again, we've seen Palantir come in and buy 50 million in gold bars. I think that's such an interesting thing because prior it was all about companies buying Bitcoin. Now you're seeing companies saying, okay, we have to be smart. We can't just put all our eggs in Bitcoin. There's too much volatility. Let's buy some gold. Same thesis applies. Printing of money. We don't want to hold too many dollars. We want to diversify out.
Absolutely. That was actually my next question, Gareth, is do you see this trend of exactly as you said, Palantir buying 50 million in gold? Is that a trend that might be starting for some of these other companies?
I absolutely think it is. Just like these companies at certain points will probably hold some Bitcoin on their balance sheet. I do think the same thing with gold. As a company, I mean, if you're a multi-billion-dollar company and now we have trillion-dollar companies, you especially a company like Apple that has so much cash on their balance sheet, you don't want to see inflation of 5 to 10% per year and basically say, okay, well, we're holding 100 billion in cash. Well, now it's only worth 95 billion. Now it's worth 90 billion. So you have to look at diversifying to keep that value of what the actual, asset is worth. Now, companies are going to recognize that without regulation in Bitcoin, it's very risky to hold Bitcoin. And they don't want to invest a lot and then see Bitcoin collapse 50%, like we saw from 65 to 30,000, actually more than 50%, and then kind of be looking the fool. Now, what they will do is just like an investment firm, they're going to diversify. So I think you're going to see some firms continue to buy small positions in Bitcoin as well as gold. And it really makes sense. Again, the amount of cash that a lot of these firms hold on their balance sheet is the equivalent to solid sized hedge funds. And they have to act smart about how they diversify, which includes buying gold as well as Bitcoin or other cryptocurrencies.
Excellent, Gareth. What about maybe let's have a look at the SLV or GDX, some of the other metals charts here.
Sure. So check this out, right? So silver's a little bit of a concern to me right now. I think last time I was on with you, I was still concerned about it. We did see a fall off on silver. Silver got below this trend line right here. So it is in a little bit of a weaker position. Now, longer term, if you ask 5-10 years out, I love silver, but I do think there's still potential downside, potentially as low as I think around 18 or so on the SLV. And I think that might coincide with around 19 on the spot price, give or take a little bit. But I do think that there is further downside. And the thesis for this is really that you have to remember that silver has that industrial component. And again, I think on past interviews with you, we've talked about how that air pocket, I expected that air pocket in the economy. I didn't necessarily see the Delta variant coming, but it was just more that investors had saved so much money. They were spending it all at once. And then afterwards, there was going to kind of be this air pocket of demand left over where it was going to go back to a more normalized amount of spending. Silver was factoring in just kind of gangbusters. We've obviously seen that start to occur as well. So I think silver in the short term, a little bit lower. I will be waiting with all hands on deck to be a buyer if it gets down to that, 19 to 18 level. And again, longer term, it's still a commodity. As the dollar dilutes, you will see silver go up quite substantially.
So before we finish out the charts here, is the trend right now in Bitcoin different than in previous bull cycles, or is it still intact the way you see it?
Yeah. So let's take a look at the Bitcoin chart. So this is a super interesting chart as I bring it up for you guys. So Bitcoin was in this range, right? We went from basically 30,000 to 40,000, chopping. We then broke out and you've seen it kind of climb up. Now, all along, I ultimately, if you ask me where this eventually will bottom out, it's probably 18 to 20,000 before it heads to 100 and then 500,000. But in the shorter term, this neckline, this is the former neckline of that Head and Shoulders that played out so beautifully. Remember what we were talking about the S&P earlier, how we broke down and then we were doing a retrace to what we call the scene of the crime, which was the breakdown trend line. Well, really what Bitcoin is trying to do is the same exact thing. Here was your trend line. It broke the trend line, and now it's trying to get back to that level. So I think there's upside on Bitcoin that could max out around 52, 53,000. At which point I do think you'll see another pretty dramatic drop. And I think it's important to recognize that in history, so if you look at the past big moves in Bitcoin, whether it was 2013 or 2017, it's important to recognize that Bitcoin has had these major falls during the end of that cycle, then huge bounces. And we're talking about, I think in 2013, it fell from 1,300 to 450, then back to 1,100, and then down to 100. And then in 2017, 20,000 down to 11,000, back to 17,000, and then down to about 3 to 4 to 5,000, right? So as of now, I'm not seeing the difference. So many people are telling me, oh, this time is different, right? But in all fairness, I heard that back in 2017 too. So I'm one of those types of investors that I need to see it be different before I believe it. So right now, the price action in Bitcoin is following the same exact kind of moves that it did in the previous two big pops and then big drops following, which again would tell us that, 18 to 20,000 is very possible, maybe in the next 6 months or so.
Excellent. So it's really just, following previous patterns that we've seen before, right?
It is following almost to a T. It's almost scary how close it is in terms of replication. Now everyone says, well, what would change your mind? So very simply, if by chance we take out 65,000, now, and then basically this is just common sense, right? So what did we not see in the previous cycles? Well, in the previous cycles, we never bounced up and then took out the high prior, right? So if we took out that 65,000, then you could say, okay, this time is different. And then the bull case comes right back in where it could go to 100,000 and beyond.
Excellent. So you and I spoke about inflation last time, Gareth. So how do you think about combating the loss of value of currency long-term, or do you just focus on trades to make up for it?
Yeah, I mean, it's so tricky because so many assets are inflated at this point. Like, for instance, recently I sold my house. I'm renting now because the real estate market to me is in another bubble. Bitcoin, I'd love to own Bitcoin. I love it long term. I got to wait for it to come in. Gold is really the only place right now where I feel comfortable having something longer term in the market or in that market versus other assets. And again, for me, I'm a swing trader, so I'm shorter term, which enables me to make money quite a bit faster than the inflation, could be even at 8% per year or 7% per year. So I think gold, and then just be patient, invest smartly and be patient for these other assets to come in. There will be buying opportunities, especially if we have long-term inflation. But again, I would wait for stuff, for me at least. And again, I just speak for myself. I'm waiting for Bitcoin to come in. Now, one thing on Bitcoin, folks, if you're someone who's like, I'm going to hold it for the next 30 years, don't worry about it going to 20 first. Who cares? Mm-hmm. If it's going to go to 100 and then 500, it's going to be small potatoes at that point. I, again, am a shorter term trader. So the difference of buying at 50 versus 20 when I'm, potentially going to then sell again at 50, wait for a pullback to 40, then play it to 65 and so forth. That's kind of how I trade in a shorter term basis.
So how do you try and stay objective and not let emotions cloud the charts? What are some of your strategies here, Gareth?
Yeah, I think the best strategy of all is just simply letting the chart dictate to you. So I find my resistance and support levels, and then I always say to myself, okay, this is resistance. So until it's proven to break through, it's going to, you have to respect that resistance level. Same thing with support. I really think that the charts help keep you more level-headed, because they're just very, you don't have a media talking head pumping something or this and that. It's just very like, this is the chart, price pattern in time, right? A bull flag's a bull flag, a bear flag's a bear flag, gap fill, double top, head and shoulders. I mean, all these patterns are very defined in what they are. And you can't kind of let emotion, like if it's there, that's the bias, right? It's all about probability. So I think that's the key. I also think being shorter term helps. because you're not looking like you don't fall in love with something for the longer term. I always tell people that if you're investing in a company, right, like people sometimes are crazy about Elon Musk and Tesla, always remember that as a company, Elon Musk is not going to think specifically about you. So you shouldn't be so much in love that you just blindly follow. I mean, don't blindly follow anyone, right? I think that's a general life lesson. But especially when it comes to companies, I always say I trade them. I use and abuse them, right? In that respect, like they're for me to make money. I make money, I'm out. I make money, I'm out. They're a vehicle to make my family better off. All right. And keep that mentality. Don't fall in love with any one stock or any one thing, because I've seen people that have fallen in love with stocks. And then, we go into a bear market and that stock gets cut in half, if not more. And it will happen again.
Mm-hmm. Excellent, Gareth. Is there anything else you'd like to share with us today before we wrap up?
No, I think again, going back to the S&P, let's follow that. I'm watching so carefully that wedge pattern that we're just on the underbelly or hitting again. I want to see how that reacts. I want to watch the volume over the next couple of days. What kind of volume do we see? Do we see any increase in volume? Do we get any words out from Jackson Hole? These are all things that'll be really instrumental in letting us know if this potential breakdown is still in play, or does it get negated over the next few days?
Perfect. Of course, your guys' website is InTheMoneyStocks.com and at Gareth Soloway on Twitter. Thanks so much for your time today, Gareth. Really appreciate it.
Thanks, Tom. It's always a pleasure. Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.